Welcome to PIMCO Pod. In this episode, we discuss a rigorous framework anchored in asset-based finance helps define the actual scale and scope of the opportunity. Stay tuned after the conclusion of the podcast for additional important information. How large is private credit's total addressable market really? By Lotfi Karui. One of the most debated topics in private credit is the size of the investment opportunity, or in industry parlance, the total addressable market, TAM. But the way TAM is typically framed can be misleading. Properly defined, the concept applies mainly to asset-based finance, ABF, and even then, only when it's applied rigorously. Across the rest of private markets, TAM is a poor fit. Under a reasonable set of assumptions, which we detail below, we estimate the long-run opportunity at roughly $6 trillion to $8 trillion. Imprecise definitions and gray areas complicate TAM estimates. The most common misapplication of the TAM label appears in direct lending, where the opportunity set is often defined as the combined size of the broadly syndicated loan, BSL, and high-yield HY bond markets. We view this as a clear categorical error. It conflates current stocks with substitution flows, implicitly assuming borrowers are indifferent between public and private channels, and that private capital can contest the entire outstanding balance. However, it is actually the flow of new financing demand from borrowers willing to pay for certainty of execution, confidentiality, and flexibility that matters. Under normal conditions, large established issuers, where most of the supposedly addressable dollars sit, appear to have little incentive to raise capital from private markets. Of course, the substitution flow from public to private markets isn't zero, and jumbo direct loans from single large lenders can, at times, displace syndicated deals, BSLs, from groups of lenders. A better way to frame this within the TAM debate is as a contested boundary between public and private markets, a boundary whose width changes with market conditions. By contrast, less precise TAM definitions treat that boundary as fixed and fully capturable. By the same logic, one could argue that small businesses and public companies alike could represent the TAM for private equity. This is clearly incorrect. For direct lending, the relevant metric was never the TAM, but rather the marginal penetration of different lenders and types of lenders into the wider market, along with the gradual back and forth drift of this overlapping boundary. Why asset-based finance is an indisputable component. ABF is different. The TAM concept genuinely applies because ABF is grounded in credit risk transformation rather than substitution flows. The underlying cash flows exist regardless of who finances them. Namely, there are identifiable balance sheets being vacated, typically those of banks and specialty lenders that want to free capacity. Put differently, ABF can be understood as a manufacturing process whereby the same collateral is tranched into different risk layers. This allows us to map the financeable universe and estimate what share can realistically migrate into ABF portfolios. To be clear, analytical rigor still matters. For example, counting trillions of conforming mortgages securitized by U.S. government-sponsored entities, GSEs, such as Fannie Mae and Freddie Mac, materially overstates the opportunity. The GSEs are not balance sheet constrained lenders. They are chartered entities with an explicit federal mandate. No private fund, regardless of its funding advantages, can realistically compete for that collateral. Therefore, what may migrate into ABF portfolios is typically the non-agency mortgage market. Jumbo loans, non-qualifying mortgage loans, and other residual risks that banks and mortgage lenders are shedding. Simply put, when applied correctly, the ABF addressable market is not everything that exists, but rather the displaced slice where private capital tends to have a genuine and durable advantage. Calculating our TAM estimate of $6 trillion to $8 trillion. Here is a useful way to think about the long-term opportunity set for private credit, and ABF specifically. Start with the major pools of U.S. lending and exclude those portions that have already migrated to institutional capital markets through securitization or long-term ownership by buy and hold investors. The largest subcategory is residential mortgages. While there is roughly $13 trillion in loans outstanding, about $10.1 trillion has already been securitized through agency and non-agency residential mortgage-backed securities, RMBS, according to data from the Federal Reserve and the Securities Industry and Financial Markets Association, SIFMA. This leaves approximately $3 trillion on bank and non-depository balance sheets. Commercial real estate CRE represents another $4.9 trillion of loans, and within that total, roughly $1.8 trillion has been securitized through commercial MBS and multifamily MBS, while life insurers hold an additional $800 billion, according to data from the Mortgage Bankers Association, the National Association of Insurance Commissioners, NAIC, and SIFMA. That leaves about $2.3 trillion still primarily funded by banks and specialty lenders that could, in theory, migrate into the ABF ecosystem. Consumer credit, including credit cards, unsecured loans, auto loans, and other receivables, totals approximately $5.2 trillion, according to Federal Reserve data. Around $1.2 trillion has been securitized through the asset-backed securities market, leaving roughly $4 trillion outside public securitization markets. Equipment finance and leasing represents another $1.4 trillion of loans and leases, according to the Equipment Leasing and Finance Foundation. Of this, only $200 billion to $300 billion has likely been securitized, leaving about $1.1 trillion still funded by banks and specialty finance companies. Beyond traditional lending markets, there is also a growing universe of contractual cash flow assets, including aircraft leases, franchise and licensing agreements, litigation finance, music royalties, and intellectual property. While it is difficult to size precisely, these markets likely represent roughly $500 billion worth of collateral, the bulk of which is $300 billion in aircraft leases globally, according to the Air Finance Journal and McKinsey. Taken together, this suggests there is roughly $25 trillion worth of loans and contractual cash flow assets in the U.S. Of that, about $13 trillion has already been securitized, and insurers hold another $1.5 trillion to $2 trillion. Dedicated ABF portfolios account for an estimated $800 billion of assets, inclusive of insurers' separately managed accounts, SMAs, according to company filings. These numbers imply that the remaining pool that could plausibly migrate from traditional intermediaries to the asset management industry is roughly $9 trillion to $10 trillion. In practice, however, the addressable market is likely smaller. We expect banks will continue to retain high-quality loans, particularly given recent regulatory relief. In addition, some assets remain operationally difficult to transfer. Therefore, based on our research and calculations, a more realistic long-run private credit opportunity, or TAM, is probably closer to $6 trillion to $8 trillion. In other words, once you exclude assets that are already securitized, held by insurers, or housed in dedicated ABF vehicles, the remaining migration opportunity is comparable in size to the entire U.S. investment-grade corporate bond market. That is indeed large, but it's an order of magnitude smaller than the $25 trillion of loans and contractual cash flows outstanding in the U.S. Thank you for listening. That was How Large is Private Credit's Total Addressable Market, Really? For future insights, please follow us on your favorite podcast platform. This episode uses an AI-generated voice. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.